Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for July 29th, 2017. Market is in bullish quiet conditions. On an annual basis, we're overbought at 97 out of 100 on NDX 260. On the short-term market condition, we are in the middle of overbought or middle of neutral, at 67 out of 100 in the market mosaic. Price with respect to the 200-day moving average is green bullish at 6.32%. The slope of the 50 is white neutral at 30.36%. ADX is a weekly trending 12.2 with bulls slightly in charge. The risk index is the 30 period moving average of the VIX divided by the 10 period. The boundary between risk on and risk off is 1.0. The current reading is 1.062, so we are into risk on conditions. The z-score of that reading we calculate by looking back 5,000 trading days, finding the average and the standard deviation, and the z-score computes out to 0.69. You can see here a 90-day histogram of that indicator, which recently peaked out just short of one standard deviation plus and is now starting to decline. So that puts us in cautiously optimistic conditions. The easier money is, if there is such a thing, is when in a bull market this risk index bottoms out and starts to climb back up like a percent price oscillator MACD histogram. So we're cautiously optimistic here on the long side. Blended monthly rebalancing, current holdings are here for what we are going to own in August. In this coming up, making these changes in the week ahead. Theoretical exposure of ETF2 is at 100%. And the models at 100% as well. Here's blended monthly rebalancing. Looks at different portfolios. There's 13 ETF. It's all on a buy signal. The 32 ETF is all on a buy signal, less consumer staples in the energy sector spider. The Dow is interesting to me, as is Australia. And in the ETF 32, EEB, the diamonds again, and some commodities starting to make the turn. In ETF Max, what I look at are those symbols on 1 week and 1 month that have made exceptional moves. Nothing really exceptional in the 1 week. On the 1 month, the momentum in China and rare earths is of interest, as is Brazilian small caps. So I would be looking for additional momentum there. In the S&P 500, now we're starting to see the effects of some volatility with great positive momentum here in First Solar, Boeing, PayPal, and Best Buy, and then a negative move here in Vertex Pharmaceuticals in keeping with its very volatile recent history. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. Here's the 60. The horizontal lines represent support and resistance levels from the past that may still function as that price target ladder. We have the slope of the 10-period regression channel up, but price pulled back to find support at the edge of the river, bottom of the dragon, and the bottom of this 10-period regression line. So there's reasons to believe in the support at 248 should hold for this bullish market to continue. The 30-period channel, lagged by a day, is still up strong. It's at a slope of 0.2. That's what this sine wave shows us, is the extremes, and then when it touches the zero line, it gets this. That means it was that 30-day slope was flat, and now it's rebounded nicely from this sell-off and consolidation, and seems to be finding some support levels here as it rolls over at 0.20, which is kind of what it did the last 2 times. Each time there was a sell-off, a recovery, and here the recovery got up to 0.23, then had a sell-off and then a recovery, and then it sold off once more, and now here's a recovery and support. So a support level down around the Bollinger Band mean Wouldn't surprise me if it came back and tested that, test the edge of the river, test the Bollinger Band mean. Really, 241 is the key for this leg to maintain its gains. Excuse me. You can see that it's just leaving a period of overbought conditions. Excuse me. The last time it did that, it had some chop for 10, 20, 30 days. Um, the percent price oscillator, which is like a MACD histogram, has closed after a nice move up. The last time it did that, again, it was this sideways chop into a slight sell-off. And this one, there was a sharp sell-off and then recovery. So looking for that kind of market behavior to continue would not be surprising if it did so. ETF2 regional report, all of these symbols are on buy signals, so the model is at 100% invested, 0% cash. The globals at 60 are better than the S&P at 54. Inside the U.S., it's small caps and tech, followed by large caps, with mid caps lagging. Two strongest sectors, emerging markets and European 350. Two weakest sectors, the S&P 500 and then U.S. mid caps. Lagging in materials, industrials, and healthcare. Strength more to be found in utilities, staples, and financials. World market model, again, U.S. mostly, well, below average, I would say. The large caps slightly above average. Asia, a mixed bag with some strength but also some weakness. Europe basically dominating. Corporate bonds doing well. Latin American emerging markets and Mexico, a real source of strength. ETF top 30, I look for the green and then white to find the new leaders at the top of the stack. So I'll be looking at home builders, emerging markets, Singapore, Taiwan, China. You see the trend there. Losing some ground here in the euros and in the biotech and the European 350. Just be cautious about those. They may have run their course. The real strength up here in greens across the board. That's fully manifested in their strength. Shifting to the daily report, a handful on the auto framer test out well. A couple channeling signals and a 5DD in XIV. MDY firing on the channeling here. Only a couple frog quality numbers better than 3. And only IBM firing on RSI2. You can see however, some nice auto framer numbers shaping up here with some typical tradables from us. This is one where I would be looking for Goldman Sachs. If it maintains its momentum from Friday, could still offer a nice favorable reward to risk. In the ETFs, a few more frog quality numbers firing. Only one symbol on the RSI2 less than 10. That's XIV. And just a handful auto framers that test out well, and some channeling in metals and mining, the weak mid caps, and then basic materials. Daily pinch and stretch report. These are the symbols that have the greatest divergence from the middle of their river in terms of their z-scores. So these are ones I'm looking at especially ones past Z2, as either a change in target condition for them that is leading to massive continuous gains, or a reversion to the mean trade back to the Bollinger Band mean. And in this case, like Boeing, it's 13.5% above its 30-period moving average. So that's quite an excursion. In this column, these three symbols, 3M, GE, and IBM, are ones that are exceptionally below their 30-period moving average, the middle of the river, in terms of their z-scores. In each case, almost 5% below the 30 SMA. The most expanded pinch boxes, these are the z-scores of the width of the river. So Nike and Boeing, very much 30 days of expanded range and volatility, leads to their high z-scores. And then these become, where the river is very narrow, very interesting in terms of pinch breakouts. Now this group down here are super pinches, and this is a case where the z-score of their pinch box on the daily is extremely tight, so less than -1 on the z-score, and all four of their regression lines are within the z3 pinch. So there's temporary agreement by all the different time horizons on the fair value, and so when you have a combination of pinch and total consensus, the next thing that happens are breakouts from that. Now this group is sorted in terms of the tightest pinch of those regression lines. So XOM and XLI to me are the ones that are most postured for these surprise moves. Now, as an example of that super pinch, here is Pfizer, and you'll notice that the Z3 lines have come together. All the regression lines are inside the Z3 channels. Very tight compression of fair value. The last time we had a pinch, well, we got short at a Pfizer here at just under 34 and had a nice sell off to 31.50. So that's a 10% move in a short period of time, followed by an owl exit. This also offered an owl reversal back to previous support levels, and now you'll notice that it's there's another owl inside here, and it's tested the bottom of the regression line channel here and the Z3 lines. So any break below about 30, looks like 33, I would be getting short down here, and I would be targeting a retest of 32, and then a dragon belly here at 31.50, and then the final support level down here at 30.50 based on this belly of the dragon. So if we get further failure, these are places I would consider tightening my stops or adding positions. If it falls through 31 or 30.50, you absolutely want to have money in hand and a double scoop position based on how sharply this has fallen in the past. So this is the case of that super pinch trade frame. On the upside, I would like an entry above. Sorry, let me pull this down here. I could see an entry above 33.50 if it departed the river, and then I would be looking for a retest of this swing high up around 34.50, and then if that breaks all the way up to 37 is where it's heading. So this is these super pinches turn out to be really nice places to get our trades on. And then if you just look back a little, the last super pinch we had was back in here where these Z3 bands pinched, and the breakout to the downside was massive and good, followed by some owls and some more owls. And then this one shows the when you get this huge divergence from the RL270 to the RL10, that fires on our stretch stat, and we get some really nice owl re-entries and 1, 2, 3 entries from Z3 excursions that get you into those kinds of moves. And then the P4, which gives you a swing low, a higher low. This to me is the sweet spot of them all, is this trade that looks for an owl entry and then a RLXD exit on the far side of the RL270. So lots of good things to look forward to in Pfizer in the days and weeks ahead. All right, so that's everything I want to cover from the daily report. This is in the weekend report. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.